Well, hello and welcome to another in our series of Choice Words videos where we get to meet the great and the good of the world of UK fund selection, fund research. I'm Julian Marr, I'm Editorial Director of Wealthwise Media, and today I'm delighted to be talking to Ian Wood, who is CIO at Titan Investment Services. Hello, Ian.
Hello, thanks for having me.
That's a pleasure. Jumping into straight question, or straight into the first question even. What most excites you about the current investment outlook? What gives you pause for thought?
I'm pretty boring answer to start with. Compound interest.
And we can build up. We can build.
Yeah.
You can build from it.
Compounding of returns is what's absolutely crucial for clients and delivering their long-term outcomes.
Mm-hmm.
So when we think about investments, we think about those businesses, those funds that can invest in assets that can generate and then compound free cash flow over a long period of time, because that still matters in the marketplace. If we can find businesses that can generate 30 or 40% return on capital, generate off free cash flow, reinvest that free cash flow at a higher return, that drives compounding of free cash flow and price as well. And the market will eventually cotton on to that, and share prices do follow free cash flow over the long term. The important caveat to that is that we don't overpay for that free cash flow up front. It's really important. The valuation discipline is really important to us. Lots of concerns around at the moment. Obviously, we've got geopolitical risk. We've got Trump in the White House making lots of different statements and changing his mind quite regularly. We try not to get involved with the noise too much. Mm-hmm. We try to think about things in the long term. There's some very smart people out there that can make investment decisions based on short-term macro and geopolitical themes. That's not our game. We're always talking about trying to deliver long-term outcomes for clients, and that comes from a selection of equity and bonds within the portfolio and other non-traditional assets.
So going off piece immediately, but just behaviourally, I mean, do you have any processes for tuning out the noise, looking long term? It's a great skill.
No, absolutely. The macro is very important, but from my view as a fund manager, and my job is to pick the best stocks within the portfolio, try and ignore the short-term noise. And we do that through behavioural processes within the portfolio, which makes us ask questions of ourselves and makes us concentrate on the long term. If you can concentrate on the long term, the short term noise becomes less important. It's always there, it's always at the back of your mind. Sometimes it's difficult to ignore it, but I think the best investors sort of ignore that long term, ignore the short term noise and really concentrate on long term outcomes for clients.
Great start. Moving from the macro to the individual stock, I mean, you've touched on quite heavily in sort of what draws your investment on the compound side. Is there anything else beyond that? And then on the flip side, what do you see as red flags in particular investment?
Yeah, that's important. I think that because we want to buy those high quality companies, everybody knows what they are.
Mm-hmm.
We're not reinventing the wheel here. Everybody knows what the best businesses are in the world. Those businesses that have got some sort of competitive advantage, sort of economic moat, as Buffett would say. Usually comes from sort of pricing power, which will be driven by brand or technological advantage, or maybe a scale advantage. Those businesses that can reinvest at a high return just generate more cash, and share prices will follow that. The really important thing here is this is not buying quality at any price. Mm-hmm. I am a Yorkshireman. I don't want to overpay for anything, and we think about valuation slightly differently. And the valuation element is where most of our work goes into. Mm-hmm. Equities are very, very long or infinite duration assets. The market finds it easy to think about things on next year's earnings multiple. I think that that's not a sensible way to think about valuation, and it's a little bit more difficult, but modelling free cash flow over time and reverse engineering a DCF to get an implied growth rate. So what's the share price suggesting about the future growth of that business? And if we can find a business that's historically grown at maybe 10 or 15, is expected to grow at maybe 5 to 10, and the implied growth rate is maybe 2 or 3, then we have a margin of safety where we could be really wrong on our investment thesis, and we can generate alpha by buying those businesses, because quality businesses from time to time go on sale. Usually something nasty like COVID or war or whatever it may be, but that's the fund manager's job then, is to go out there and pick up those, be unemotional about it, and pick up those quality assets at the right price, and that should drive returns for clients in the future.
Very good. To what degree do you think professional investors need to look beyond traditional assets, let's call it cash, equities, bonds, into other parts of the market, alternatives?
And we do invest in alternatives at Titan. I think equities, cash and bonds will always be a core part of portfolios. We have a long-term history of how these things behave and what the returns that they generate. I think the important thing about alternative or non-traditional assets is we have to understand them properly. You know, crypto assets, for example, would be a prime example of that. You know, I can't value cryptocurrency. I can't value gold either, but I have 100 years worth of data on gold, which tells me how it behaves. I don't have that luxury in the non-traditional crypto assets. So we need to build a valuation framework so we can understand that we're buying. So at the end of the day, we are fundamental investors and we want to be able to buy things at a discount to fair value. That's how we can add value over time. So they've definitely got a part to play. And, you know, infrastructure assets or, you know, some private assets are really important parts of the portfolio. We do invest in those at Titan, but we've got to have a really good understanding before we have the confidence to expose our clients to them.
Thank you for that. Moving on to client comms, what's your approach or the Titan approach to client communications, and specifically the one that interests me is trying to, when I talk about the right client, what I mean is keep sort of educating a client so that ensure they stay along the full journey and get the full benefit of investing with you.
Yeah, I mean, they're just completely open and honest. So, you know, a macro piece goes out on a monthly basis. My background is private client portfolios up in Harrogate, which is a business that Titan acquired about 3 years ago. So we constantly write to clients, and that's been taken on by the wider group now. So communications have become a lot better in the last sort of 18 months. We want clients to be comfortable. There is volatility in the market. We want people to understand that volatility is not the pure measure of risk. And I think that it's important that we hold people's hand through the journey, because investing can be quite an emotional thing for clients. You know, if you've worked your entire life, saved a nest egg, and then you give it to an asset manager to look after, then they have got a duty of care to make sure that you are invested in the right assets, and also to make sure you feel comfortable along the way.
Very good. More personal question now. What was your path into investment, and if you can think of an alternate universe, what would you be doing if you hadn't taken that path?
Yeah, so I did physics at university, so I'm very mathsy and quantitative. I probably couldn't see myself doing anything else other than that. I have to have sort of a process and a lockdown approach to doing everything that I do. I like to build things, so I build lots of financial models. You know, I'm not building brick walls, but at the end of the day, I like to say that this is what I've done. This is going to help me be a better fund manager in the future. I wanted to be a professional sportsman. You know, cricket was my game. I realised quite early on that I was pretty rubbish, and so I gave up on that quite quickly. And I think if I'd not gone into this, it would have been something analytical, something quantitative, probably an engineering sort of background, I would imagine.
I'm going to go back actually in terms of on the comm side quickly. The risk. How would you explain risk? I know risk means different people,
Yeah.
different people. But how would you explain risk to someone who doesn't work in investment?
Definitely not volatility.
Sorry, yes.
Yeah, I think that volatility is a very, very blunt tool. For me, it's, you know, permanent loss of capital. And not meeting clients' outcomes. You know, clients give you the money because they've got an end goal in sight, and it's our job to make sure that we meet those expectations. I think that the market is anchored on volatility because it's easy to calculate, and I think the industry is inherently quite lazy, so we tend to use P ratios or volatility because they are simple things to calculate. But I do believe that in the long run, meeting client outcomes and making sure that we generate the returns that are offered in the marketplace is absolutely the risk that you take when you put your money with an asset manager.
Thank you. And just taking advantage of your physics and maths background, the rise of AI, you see that as an opportunity or threat, or both to investment?
Both, absolutely, yeah, both. I mean, we use it. It's great for doing sort of the deep dives, analytical deep dives, and looking at large amounts of data. But I think the prompts are really important. You know, I mean, a number of times over the last year or so, as this sort of thing has sort of come to the fore, you know, we've had some pretty dodgy output from the AI models, and the AI models are great. It's usually the prompt that's incorrect. You have to double check everything that comes out of it. And I just worry that we just become over-reliant on it, and it stops you thinking for yourself. And at the end of the day, you know, AI is great for doing that data work, but it's not got the ability to understand business nuance or whatever it may be. That still requires a human being to have oversight. So, you know, really, really powerful, really, really exciting, but then slightly terrifying at the same time.
Very good. From computer mistakes to personal mistakes. What's the biggest investment mistake you're prepared to admit to, and what did you learn from it?
Yeah, I mean, I don't think anybody should be scared of admitting to mistakes. I think it's dangerous if you can't admit to mistakes. So going back a few years now, I mean, look, we make, fund managers make mistakes from time to time. It's part of the job. You have to get used to it. I think if you're the sort of person that can't admit that you make mistakes, then you're probably in the wrong game. So there was a business, it was a semiconductor business 5 or 6 years ago. I was looking on our spreadsheets and all our models. It looked absolutely fantastic. It was great value optically. It was, growing very, very quickly. It was a high quality business. But I made the mistake of looking too short term. So I was looking at near year earnings multiples. And I failed to understand how cyclical that semiconductor cycle can be, particularly in memory. It was a really poor investment for us as a result of that, and the lesson that we learned from that was, stop looking at near-year earnings multiples, model the cash flows, understand what future growth is required to justify the current share price, and then we can make a judgment call because we've framed the valuation argument. I think unless you do that, there's no formula out there that tells you what EV/EBITDA multiple a stock should trade on for a given level of growth or a given level of quality. It's all too subjective. So I try my best to quantify everything, and a reverse DCF is the way that we did it. And we sort of generated that process 5 or 6 years ago as a result of the mistakes that we'd made by investing in optically cheap earnings multiple stocks.
Thank you. Home straight now, just a couple of good questions. What advice would you have given yourself, or you would like to have given yourself on your first day in the business?
Probably be more patient. This is a long-term game. I think when you first come into the industry, it's you think that the investment fund management industry is an exciting place to be. I think at the heart of it, it should be quite dull and boring if we're going to give people good outcomes. I think that my view is that if you can compound clients' assets at 8 or 9 or 10% a year, which is what equities broadly give you, then that's a really attractive outcome. I have a strong view that some sort of basic financial maths should be sort of taught in schools, because I'm pretty sure if you give a bunch of kids a number and say compound that at 8, 9, 10% for 40 years, you will definitely get their interest. And I don't think I understood that when I first came in. I thought it was all about not getting rich quick, but buying the go-go stocks. And actually, in reality, you generate more wealth for clients by buying good quality businesses. It is definitely the most sustainable and consistent investment methodology, and so that's why we do what we do.
Last question, then. We call this choice words because of the professional choices you make, but a couple of personal recommendations from you. One would be for a book recommendation, can be on investment, doesn't have to be, and the other one is well, it's actually a free hit.
Yeah, so the book is, I mean, I don't do an awful lot of reading, so this is a very short book. So it's Joel Greenblatt's The Little Book That Beats the Market. Short but incredibly powerful. Yeah. A great way of thinking about return on invested capital. He wrote that book to, it's probably a sign of my sort of level of intelligence, but he wrote that book to teach his kids and tell his kids what he did for a living. And that really resonated with me, and buying those high return on capital businesses as what's proven to be very successful for me in my career in terms of investing in high quality companies.
Good stuff. And at a free hit, I mean, I think of various things we've had. We've had golf courses, restaurants, podcasts, sitting in St Paul's Cathedral. As a life experience you want to recommend someone? Or?
Yeah, so my kids play cricket, and I have 2 boys and a girl. They all play cricket. So my entire weekend, every weekend, is going and sitting down for 7 hours watching either of my boys play cricket wherever they're playing on that particular day. And I love cricket, but I do appreciate it can be a little bit boring from time to time. And I think that you've got to get away from the screens, and it's a perfect opportunity for me to get away from the screens. Probably do my best thinking, sat in my deck chair watching the kids play cricket. The prices on the screen can be your worst enemy. It can make you behaviourally react to situations in a bad way. So we try our best, myself and my wife, to have as much downtime away from this, because it can be all consuming. Just time away from the screens. It's cricket for me.
Nicely done. Good, yes, good life philosophy. Those are great choices and a great interview. Thank you so much for your time, Ian.
Thank you.
And thank you very much for watching. Please do look out for further Choice Words videos as they are published.